Good afternoon. This is Josh Minzlin here at Chaikin Analytics, and I'd like to welcome you to the best stocks for 2019. Our presenter today is Dan Russo, Chief Market Strategist at Chaikin Analytics. Chaikin Analytics is not registered as a broker-dealer or investment advisor either with the U.S. Securities and Exchange Commission or with any state securities regulatory authority. Chaikin Analytics is for educational purposes only and is not a trade advisory service. Past results of any trading system or methodology do not guarantee future results. Be sure to submit your questions for the webinar using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. I will be available to respond to your questions throughout the webinar. This webinar is being recorded, and a replay will be sent to all registrants tomorrow. Dan Russo started his trading career as a specialist and member at the New York Stock Exchange. Prior to joining Chaikin Analytics, Dan was an institutional sales professional where he combined the firm's fundamental analysis research with his own technical analysis to generate trading and investing ideas for hedge funds. Dan is a chartered market technician and is the co-chair of the New York Chartered Market Technicians Association chapter. To get us started, here is Dan Russo.
All right. Hey, Josh, thank you for that warm introduction. And thank you, everybody, for joining us here today. Another volatile session in the market that just seems to be the theme as we head into the end of 2018, kind of playing off really everything we've seen so far this year. So as the year winds down, I kind of want to walk through, how to identify the best stocks heading into 2019, kind of walk you through our process for finding those names, and equally as important, knowing when to get out of them, knowing when to take your profits and move on to the next idea. But before we do that, just a little bit of background about myself. As Josh said, I am a CMT. That is a chartered market technician. I spent 18 years on Wall Street, former New York Stock Exchange market maker. I actually started my career on the floor of the New York Stock Exchange as a summer intern when I was 16 years old, and they liked me enough to have me back every summer until I graduated college. And then my first job out of college was working at the New York Stock Exchange. I worked my way up to become a market maker and then transitioned away from the floor. And it was during that time off the floor that I became a chartered market technician, and something else that I'm really proud of. I'm chairman of the New York chapter of the CMT Association. So the CMT Association is the group that administers the CMT exam, and the New York chapter is one of the largest chapters in the world. So I was honored to be asked to be the chairman of that chapter. And in obtaining my chartered market technician designation, kind of similar to the CFA, a three-part exam, self-study over the course of 2 years, and thankfully I passed all three parts in one try. So that's how I come to the markets. And prior to joining Chaikin Analytics, I spent 10 years, as Josh said, covering hedge funds, but also large institutional investors. I sat on a sales and trading desk and had a stable of fundamental analysts that looked at every sector and industry group in the market. We covered over 350 individual stocks, and I would use their fundamental research in conjunction with my technical analysis to generate actionable trading and investment ideas for my clients, these institutional investors. More importantly, for 10 years, I had a front row seat in how these money managers look at the markets and come to their investment ideas and how they put money to work in the market every day. And then also, here's an action shot of myself. I'm a frequent guest on Bloomberg TV. So that's obviously an honor. Every time they call me, I'm jump at the opportunity to get on there and share my views. So what I'm going to talk about today are the keys to a repeatable stock selection process. And really, it boils down to 5 key points. First, identify the strongest and weakest areas of the market. Then, buy bullish stocks when they become oversold, and simultaneously avoid bearish stocks, or buy put options on bearish stocks, especially when they become overbought. use our signals to enhance your performance. I'm going to walk you through our proprietary signals that help you get into these positions. And then I'm going to show you, using our tools, how you can know when to book a profit on one of your winning trades once you're in the trade. So first, I kind of want to open it up to a poll here. And Josh, if you could poll the audience, I'm kind of interested. What is your view on the stock market in general, on stocks in general, heading into 2019? And I'll give Josh a minute to open that up for you.
Sure, hopefully everybody can see the poll. It's up. Got a lot of people flooding in answers. Give me 1 second and I will.
That's great.
Everybody. Yeah. We got almost over 90 recipients. Let's see if we can get over 100 and we're going to cut it off so we can keep moving. All right.
So it can be statistically significant.
That's right. We want a good sample size. I think we got it. Thank you all for your response. I'll share the results with everybody. Can you see that, Dan?
So it looks like 15% of you are bullish, 17% are bearish, and 67%, so the majority, is cautious on markets heading into 2019. And I don't think we can argue with that view. I think that that's the view that makes sense in light of what has happened here in 2018. I know it seems like a long time ago, but 2017 was a nice, tranquil market. We call it an uptrend on autopilot. And that gave way to not one, but two roller coaster of corrections here in 2018. Remember, we started the year with that big sell-off from the January highs, and then started to make our way back throughout the spring and summer, traded at new all-time highs only 2.5 months ago in September. And now we've corrected again over 10% at the lows. And we've seemed to have settled into this volatile range bounded by about 2630 on the S&P 500 to the downside and 2815 to the upside. So just in light of what has gone on recently, I'm not surprised. That's basically the result that I was expecting for investors to have a cautious view heading into 2019. And what's interesting to me is that what we've lived through this year is actually perfectly normal. You know, we like to kind of take a historic view of the markets, right? I work for Mark Chaikin. Mark's been, in the business for over 50 years. So a tremendous resource that I get to work with every day, especially when it comes to market history and what different market environments were like. And, he pointed this out to me and showed me this chart. And he said, Dan, let's put everything into perspective. What we're seeing here is normal. This chart goes back to 1945, and it encompasses about 73 years worth of data. And you can see we've had 75 declines of 5 to 10%. The average of those is about 6%. They last about a month, and then we recover back to all-time highs within a month. So that's roughly one a year. Now, what we've lived through now is we've seen 10% corrections. The 10% to 20% corrections, we've seen 27 of those over the past 73 years. So that works out to about one every 3 years. And if you look at the last time this happened, it was late 2015 into 2016. So essentially, we're right on schedule. We were due for the market environment that we're seeing right now. And I argue that these market environments are constructive because it's these corrections that allow us the opportunity to get, better than money market returns for the work that we do here in the stock market. Now, assuming this is a 10 to 20% correction, the average decline, we're right in line essentially, is about 13%. The average length of the decline is about 4 months. And then generally within 3 months, we recover and move back to all-time highs. And one of the reasons that I wanted to kind of poll the group and get a sense for your sentiment is because it lines up with what we are seeing in the marketplace right now. Fear has gripped the stock market. This is the CNN index, fear and greed index. And a lot of times, I use this in my work every week. And a lot of times it can serve as a contra indicator. Remember, the two main emotions that drive us in the market are fear and greed. And this is as of last night. You can see December 10th at 5:08 p.m. The market is in a mode of extreme fear. We were actually worse than we were a month ago when the reading was at 18. A week ago, we were simply at fear. And a year ago, right, if you remember what was going on a year ago, we were in the midst of that year-end rally. We were in a greed mode. Now, and remember, in a greed mode at the end of 2017 set the stage for the top and then sell off in January and February of 2018. So now I think it's kind of constructive to look at sentiment and take a look at where the market is holding support at 2630. With this extreme level of greed in the market, I actually think that there are opportunities out there if you're in the right parts of the market. And that is one of the key themes that we're going to look at today. Because ultimately, at the end of the day, it is our belief, and I've seen this through 10 years covering institutional investors, through becoming, even as a chartered market technician, fundamentals drive the market. But it is our emotions as humans, those fear and greed emotions, that drive the market to extremes. And your opportunity, your path to profit during those sell-offs that are a regular part of the market, is to combine fundamentals with technicals and to take emotions out of the equation. Because honestly, at the end of the day, the headlines are not your friend. The headlines are there to feed off of your fear and greed emotions. And I wanted to call this out because it really jumped out at me. These are from last week from wallstreetjournal.com. The first headline is from December 3rd. So last Monday, if you recall, the market gapped higher and ran to 2,800, and everybody was feeling good about the easing of trade tensions. And if you were tempted to read a headline like this, or any of the other number of headlines that was coming out throughout the day on Monday, and you were tempted to buy stocks on December 3rd, well, you were in for a rude awakening when you came in on Tuesday, the next day. And here's the headline from the next day: Dow tumbles nearly 800 points as trade jitters return. So the trade fears were eased one day and back the next. Trading off of your headlines, which are designed to feed off of your emotions, are not a repeatable strategy for getting outsized returns in the marketplace. And the problem is, we are bombarded with information like this, especially in volatile market environments. It's a flood of information. I mean, I come in every day and my email inbox is inundated with thoughts and ideas and perspectives on the market. You know, why we're going to rally from here, why this is the start of a bigger bear market, and you should go to cash right now. And the problem with a lot of that is, number one, as I said, it feeds off of our emotions. And number two, it doesn't tell me anything really. It doesn't give me the answer to the question, how do we know what to buy and when to sell? Because as I'm going to show you, regardless of the market environment, there are opportunities out there both for the bullish side of the coin as well as the bearish side of the coin. So the solution to that flood of information to help you figure out what to buy and when to sell is Chaikin Analytics. It's our platform for desktop as well as for the iPad. And everything that we do stems off of the Chaikin Power Gauge rating. It is a simple, not simplistic, but powerful tool to give you an indication of a stock's potential. It looks like the gas gauge on your car. It runs from very bullish to very bearish. And I call it your GPS for navigating the market. And really, the power gauge rating helps you know where a stock is headed. It's clear and a tested summary of a stock's potential. And what really drew me in to Chaikin Analytics when I received a phone call. I was sitting on the trading desk, and I received a phone call from Mark Chaikin, and he introduced himself. Hi, this is Mark Chaikin. And I kind of stumbled over myself in complete shock, because I had obviously studied about Mark Chaikin and his indicators while becoming a CMT, that I think I said something really silly to the effect of, you like the money flow guy? And he said, yes, like the money flow guy, as well as some other projects that we've done. And he started telling me about the power gauge rating. And the deeper I dug into it, the more I realized that the factors that make up the Chaikin power gauge rating for individual stocks and now ETFs are the same factors that my clients, those hedge fund managers and those mutual fund managers, are looking at on a daily basis, right? The value investors are looking at the financial metrics. They're looking at, they're concerned with long-term debt to equity. They're concerned with value, so they don't want to pay too high a price relative to book value or relative to sales. They do a lot of work to try to get a gauge of a company's free cash flow as well as their return on equity. Now, our growth investors, now I covered them all, value investors and growth investors. Growth investors look at earnings growth and earnings surprise, and is the trend in earnings heading higher? And they're not so much concerned with the PE ratio. They're more concerned with, is that earnings number growing? Are there reports surprising to the upside? And are they doing that in a consistent way? From there, we layer in the technicals. And as I said, I'm a technician, but I understand that fundamentals drive the market. And within our model, technicals are only 15%. The bulk of the model is on those fundamental factors that drive stocks. And then, our secret sauce is what we call experts, but you can think of it as sentiment. It's what are the really smart people in the marketplace doing on a daily basis that could impact a stock's performance. So we look at the earnings estimate trends. What are the Wall Street analysts doing with their earnings or estimates? Are they raising them, or are they taking them down? We look at short interest. Short sellers tend to be the smartest investors on the street. I covered some funds that were designated short-only funds. And think about that. They're still in business. We have been in a 9-year bull market, and these short sellers in a 9-year bull market are still in business. So I like to pay attention to what they're doing. Insider activity, obviously really important. Who knows the company better than the people who run it and work there? And then we look at analyst ratings as well as industry relative strength, because the key to finding winners really is relative strength, and we're going to go through that in a moment. But at the end of the day, what the power gauge rating does for you is it brings all of those factors that professional investors are looking at on a daily basis, and we cut through all of the clutter and give you one rating that is a simple explanation of a stock's potential based on the factors that fall into those 4 categories: financials, earnings, technicals, as well as the expert activity. And you can see here the performance of the power gauge rating has been very, very good. Our bullish, this data goes back to from 1999 until the end of 2017, and it combines backtesting data as well as real world performance. And you can see that our very bullish and bullish stocks have outperformed the Russell 3000 over this time frame, and our bearish and very bearish stocks have underperformed the market in that time frame. So as you're looking for ideas, stocks to buy, wouldn't it be great to be able to narrow the pond where you're fishing down to just very bullish stocks and bullish stocks? I mean, what would that do for your trading performance if you just tilted the odds in your favor just by using the Chaikin power gauge rating? Now, we're going to go through and look at some of the other metrics that can really enhance your performance. And at the same time, think about what it would do for your portfolio if you avoided those bearish and very bearish stocks that tend to be the landmines that kill portfolio performance over time. So I'm going to walk you through now my top-down process for identifying stocks that are likely to outperform as well as stocks that are likely to underperform. Now, as I said, everything starts with the Chaikin power gauge rating, and then from there we look at industry group strength, and we want to know which industry groups within the market are leading and which are lagging. After that, I want to know what the institutions are doing. And, Mark's indicator, for which he's most famous, the Chaikin money flow indicator, is available on most technical analysis platforms, and it really gives you an idea of what my former clients, those institutional investors, are doing. And when we combine that with relative strength, we can identify the potential winners and losers, and then we can use our proprietary signals to tell us when to buy the stocks that are likely to outperform and when to sell the stocks or take bearish positions in the stocks that are likely to underperform. So as I said, we talked about the market and how we're in this volatile trading range right now between 2630 on the S&P 500 to the downside and 2815 to the upside. But within the market, there are different sectors and industry groups that are leading and different sectors and industry groups that are lagging. And one of the tools that we provide to you when you become a Chaikin Analytics member helps you identify the parts of the market that are likely to continue to outperform. So when you're going to look for long ideas, you know which parts of the market are most likely to produce your outperformers. And again, it all stems from that power gauge rating. These bars here tell us that within the XLU, the utilities ETF, there are currently 17 bullish or very bullish stocks, 11 neutral stocks, and 0 bearish or very bearish stocks. Real estate, 5 bullish stocks, 3 bearish stocks. You get the idea. We know that in this market that's become more defensive, the parts of the market that are likely to produce our outperformers are the defensive sectors of the market: utilities, real estate, and the defensive parts of healthcare. And we can see at the bottom, we want to avoid energy, no bullish stocks, 10 bearish stocks. We want to avoid the industrials, only 2 bullish stocks for 23 bearish stocks, and tech rounds out the bottom 3. And if we actually wanted to take that level of analysis another one step further, we can run in the same level on the different industry groups that make up these sectors. So it is a top-down approach to the marketplace. And once we've identified the types of stocks, the parts of the market where we want to be looking for our long ideas, we give you the tools to identify the stocks that make the most sense to buy. What we like to call our Chaikin Classic Bulls. A Chaikin Classic Bull is a stock with a bullish or very bullish Chaikin power gauge rating, has strong relative strength, i.e. it's outperforming the market, and has strong Chaikin money flow, meaning my former clients, those institutions, are accumulating the stock. And a great example of that through the majority of this year has been Centene Corp. Centene, we read our charts from the bottom up. The ribbon at the bottom of the screen tells us what the power gauge rating has been, and we can see Centene, it really started to become a bullish stock around the March-April timeframe. Above that, this is that relative strength. Stock has been outperforming the market since March, and you can just see, here's Chaikin money flow. Look at these big mounds of green. These are institutional investors clamoring to own this stock, and that is what generates this steady uptrend for the stock. These are the classic bulls, are the types of stocks that we want to look for in leading parts of the market. And the flip side of that, the names we want to avoid is just the opposite. The names to sell are your Chaikin Classic Bears. These stocks have bearish or very bearish Chaikin power gauge ratings, weak relative strength. They're underperforming the market, and institutional investors are selling them. And we can see that because Chaikin money flow is weak. And, a great example of that throughout the entirety of 2018 has been Whirlpool, literally a household name. You probably have their appliances or some of their appliance in your homes, but this has been a bearish stock since February. It's been underperforming the market all year, and you can see the nice steady downtrend. And even as it trends lower, institutional investors are unloading the stock. We were actually able to identify this as a bearish trade idea for our clients back here when it was around $150. And it went down. It actually at one point recently traded under $100. So if you don't take anything else away from my presentation today, I think the key point for identifying winners and losers is a combination of the Chaikin power gauge rating as well as Chaikin relative strength. We call these the dynamic duo. And when they're in gear, they find big winners and losers because superior returns come from stocks that outperform the market. So much so that relative strength actually stands alone as a bullish or bearish indicator. So, and why is that? Because the majority of professional money managers at mutual funds are measured against a benchmark, the most common benchmark being the S&P 500. So for those money managers, it's not enough for them to own a stock that goes up. They have to own stocks that go up more than the market. So if they own a stock that's up 15%, that might be great. But if the market was up 25%, they underperformed. That is why relative strength is so important and is one of the key inputs to my process on a daily basis. But we take it one step further for you and actually help identify when is the best time to buy those classic bulls and when is it the best time to sell those classic bears by providing for you 6 sets of buy and sell signals. So once we've identified the types of stocks that we want to buy in the leading parts of the market, we then help you identify the exact opportune time to enter a position in those stocks. So now I'm just going to take you through a few examples of how I look at the world. I tend to think very thematically. Remember, I talked about identifying the parts of the market that are outperforming and identifying the parts of the market that are underperforming, and then from there isolating bullish and bearish ideas. Well, one of the parts of the market that's actually had provided a lot of opportunity this year has been retail. Earlier this year and in previous webinars, I dubbed it the retail renaissance because back a little over a year ago, it was actually the day before Thanksgiving last year, I was invited to come on to Bloomberg TV. And as we were heading into the holiday season, the host, Abigail Doolittle, wanted to talk about the retail stocks. And at the time, the retail stocks had been left for dead, right? Nobody wanted to own a traditional retailer, especially a mall-based retailer, just given the threat from Amazon. The general thesis was Amazon is going to put everybody out of business. And I was looking at the charts, and I just said, this seemed overdone to the downside. And from covering institutional investors, I knew that the consensus trade was to be long Amazon and to be short all of those other retailers. And at the time, I said, well, I still like being long Amazon, but I think it makes sense to cover the shorts in the retailers and actually start to go long. And you could see that really from the end of 2017 until about October this year, that call played out. The retailers were outperforming the market and were in a steady uptrend until October. Market started to sell off and the retailers are now underperforming. Here's that relative strength at the bottom of the screen. You can see we went from steady outperformance to now underperforming the market. So while the retailers were outperforming, I had plenty of opportunities every day in my note to Chaikin Analytics clients to identify bullish ideas for our clients to consider within the retail space. And one of those ideas was Ross Stores, right? It was back in late August. Ross had pulled back temporarily to the $90 level. It had a very bullish Chaikin power gauge rating and was outperforming the market. So that dynamic duo was in gear. Institutional investors had been buying the stock, big mounds of green, money flow coming in. And our proprietary overbought, oversold indicator dipped into an oversold condition, setting up a great opportunity to enter the trade. And actually, a couple of days later, one of those signals that I was mentioning triggered, this one being a momentum breakout signal. So with the stock at around $90, I recommended it as a long idea to our clients. And that's great. We have all the tools to get you into the trade. But once you're in the trade, How do you know when the trade is played out? How do you know when to book your profits and move on to the next money-making idea? And what I'm going to show you here is, what we call a secret sell signal, because it really is, because 95% of traders don't see this signal. We call it the Chaikin bearish money flow sell alert. And the reason a lot of traders miss this is because the institutional investors try to hide their activity. They know that if people get an understanding of what they're doing, that it could move the market and make it harder for them to buy and sell stocks. So the way that we capture that is with our Chaikin money flow indicator. So here's Ross Stores again, and here's that trade setup. Back here around the $90 level, triggered the signal. And notice what happened. The stock, nice, steady move up to about the 105 level. But look at Chaikin money flow near the highs. Chaikin money flow turns bearish near the highs. A lot of people can get you in and out of a stock, but we give you the tools to get you out of the stock at the most opportune time. We could see here that institutions were using strength to sell their positions in the stock when it was over $100. And notice what happened. Money flow continues to be negative, and the stock is now underperforming the market, and the Chaikin power gauge rating has actually moved to a bearish rating. Now, what would it have done for you if you had entered this stock at $90? And maybe, listen, I'm not saying you're going to top ticket and get out right at $105, but when this stock rolled over and broke through our long-term trend line, and you saw that institutions were selling the stock, you still could have sold it for a nice profit. We'll help you get in and give you the tools you need to get you out and keep those profits, because for me, there is nothing worse, in my opinion, than round tripping a stock, buying it at $90, watching it go to $105, and still holding it as it goes through 90, and in this case, below. The stock, this is as of this morning, the stock was trading down around $77, so about 26% from those highs. Macy's, another great example of this. When retail was outperforming, we identified Macy's near the $28 level. Dynamic Duo was in gear. Bullish Chaikin power gauge rating outperforming the market. Stock became oversold with strong bullish money flow. We identified it 3 days later. Signal. And the day after that, the stock reports earnings that beat expectations. Stock gapped higher and ran to $40. We entered the trade at around $28. Stock trades at 40, pulls back, and then attempts to break out again. But look what happened on this breakout attempt, the second breakout attempt. Institutions are selling the stock. There's that stealth signal that most people miss. You're in the stock at $28. It goes to 40, turns sideways here. As the stock is turning sideways, institutional investors are selling the stock. We give you the tools you need to see that. Stock breaks down. You still could have sold the stock here at a profit even after this gap down, but look at what's happened now. All of these profits from this gap higher have evaporated. Stock is now underperforming the market, and the rating has downgraded to a neutral plus rating. So essentially, at the end of the day, what we're looking for is what we call the ideal setup. Warren Buffett calls it the fat pitch. Right? He's famous for saying they don't call balls and strikes on Wall Street, so you don't have to swing at everything. You can wait for your pitch. And when you become a Chaikin Analytics member, I help you identify that fat pitch, that ideal setup, and we give you the tools you need to get in and the tools you need to get out. So another theme that persisted throughout 2018 was software outperformance. Famous venture capitalist Mark Andreessen has a famous quote out there, software is taking over the world. And I don't necessarily disagree with that, but that doesn't mean it's always the right time to be long the stocks, right? But for most of 2018, it was. This is the XSW in a nice steady uptrend, outperforming the market throughout the majority of 2018 until recently. And look at what happened here. That bearish money flow sell alert works on ETFs as well. As the stock was trading near the highs up here around $90, or the fund rather was trading near the highs, Institutional investors started selling the stock, and the stock began to underperform the market. And our power gauge rating for ETFs went from bullish to neutral. Now, Adobe has been a bellwether name within the software space. And back in May, we identified it as a long idea around $220. Nice, steady uptrend, hugging our rising long-term trend line. There's our signal, that relative strength buy signal. While the stock has bullish money flow and is rounding out of an oversold condition, outperforming the market, sets the stage for a great entry to the long side. In the stock at around $220, it trades close to $280 and then began to roll over. And look at who was selling the stock. The institutional investors were using this strength to start to unload their positions, and look what started to happen down here. The intensity of the stock's outperformance relative to the market began to wane. This gave you the heads up that now was the time to take your profits in a winning trade. And this chart is a couple of months old at this point. I'm using it for illustrative purposes, but Adobe continues to kind of grind in the 240 to 250 range right now. Not really outperforming, not really underperforming. It's kind of dead money. It's not where you want to be. We want to be looking for opportunities in the parts of the market that are outperforming. And here's a small cap name, Blucora, same type of setup. Stock was grinding along, and in March begins to outperform the market with bullish money flow. And when it became oversold, it triggered an oversold buy signal, and we identified it as a long idea for our clients in one of my morning notes. 3 days later, blowout earnings, stock gaps from $24 to $30, on its way to $40, and then begins to churn sideways. And it's during this sideways churning that the institutions start selling again. This was your exit signal. This was your opportunity to see that the stock is overbought with bearish money flow and its relative performance is waning. When the stock was in the $34 to $36 range, that stock is trading near $30 today. So we could get you out and keep your profits, move you on to the next idea. And it's that type of process, knowing what to buy and knowing when to get out, that helped Ken turn his account in 7 months from $235,000 to $1.2 million. I would not have been able to achieve this without your system, is what he told us. Moving on to another leading group now. Healthcare, especially healthcare services, has been and remains market leadership. Been outperforming the market since the January, February timeframe. Nice, steady uptrend. You can see it here. We've been able to identify a lot of names in this group. One of them was WellCare when it was around $240. Same setup. You see how this repeats? The process is repeatable over and over again using these tools. And I will point you in the right direction every day in my note that you will receive as a Chaikin Analytics member. Stock pulled back to around the $240 level and triggered an oversold buy signal where we identified it as a long idea. Look at the money flow, was bullish. Stock rallies to $320. Starts to top out, and look who was selling. My former clients are in there using these highs as an opportunity to get out of their positions. If you were in this stock at $240, even if you didn't get out at the absolute highs near 320, when the stock starts to roll over and cuts below the long-term trend line with bearish money flow, you could have booked your profits right here at $300 and avoided that dreaded round trip. Notice now that the stock is underperforming the market. You could have gotten out of a name like WellCare, and this is an interesting name for right now. This chart is as of today. You can keep your exposure to a leading group by rotating to a leading stock. This is Universal Health Services. You can see it's been outperforming the market since August. We're currently on a bullish Chaikin power gauge rating. So that dynamic duo is in gear. The market and the model are in agreement. And we can see that the stock is getting close to an oversold reading with bullish money flow. Institutions are not selling the stock here. This is just a garden variety pullback. Maybe it's retail investors. Maybe it's some of the algorithms, but the big institutions that drive the market are not unloading their positions in this stock. And this pullback to the 125, 130 level has set up a compelling opportunity to maintain exposure to the healthcare services space in a name that's outperforming the market. So now I'm going to open it up. I want to open another poll because one of the questions that I get asked the most is, Dan, how do you find these ideas? And I know that there are a lot of ways to get ideas. So Josh, if we could open it up, I want to ask all of you, how do you find your trading ideas?
Should we open up a poll to everybody? So just like before, if you would, and we'll give you a little bit of time to plug in your answers. Let's give it another few seconds here, Dan, and then we'll share the results. All right. There you go.
So 31% TV and the Wall Street Journal. And we just talked about how, the media plays off of our fear and greed emotions. Only 12% use social media. I would say that that's probably a good thing. And 58% of you use Wall Street research. Well, remember, it's what these Wall Street analysts are doing that go into our model. And we have a screen and screening capabilities to help you find ideas. The research is done for you, and you can screen for the ideas that meet your criteria based on the power gauge rating and these other technical aspects that I've been talking about. And what I love about this is we can take a universe of over 4,000 stocks, nearly 4,400 stocks, and identify the ones that are bullish or very bullish, that have become oversold with strong money flow and strong relative strength. And I like to keep it to the names that are over $10. So in 4 mouse clicks, you can identify the names that I identify every day for our clients. And this is a screen that I use. And this screen was run this morning. You can see here, it's called Bullish Ideas. I ran this screen this morning. We're talking about stocks that look interesting into 2019. I would encourage you to look at some of the names that are on this list because I ran this screen this morning. As a matter of fact, in my note to Chaikin Analytics clients, this name right here, Willis Towers Watson, was my bullish idea of the day. You can see it triggered a buy signal today. It's a bullish stock that meets all of the criteria that I look for. The research is done for you. I identified it as an idea today, but I could have easily picked any of these names as a bullish idea today. So let's take a look at some of them too. I want to give you some good ideas as 2019 winds down, as 2018 winds down, and as we go into 2019. One of them is Starbucks. Starbucks was on that list. And incidentally, Starbucks was Mark Chaikin's bullish stock of the week this week in his Sunday Market Insights note to our clients. And you can see here the very bullish rating, bottom of the screen. Very bullish stock since November, been outperforming the market since the end of October. Money flow, and what we look for here now is the persistency of money flow. You can see that money flow, institutional investors have been coming to this stock really since the July timeframe. Earnings announcement gaps the stock through the $62 level. I think that as long as Starbucks is above $62, it's a compelling on the long side. I love seeing Mark make this his stock of the week this week when I opened up my version of the letter. You can see here, setup is great. The stock is oversold. And there's that signal. There's that oversold buy signal. That actually triggered over the weekend when Mark made it his bullish stock of the week. So, and that's right off of that screen. 2,400 names down to 25 names in 4 mouse clicks. You can identify these names as well. Another one of the names that was on that list, this is Molson Coors. You can see here, right? Steady downtrend in the stock, but look what's starting to happen. The power gauge rating went bullish at the end of October, and in early November, the dynamic duo got into gear. Stock is beginning to outperform relative to the SPY, And as the stock moves sideways here, look who's buying now. We showed you plenty of examples of when to get out of a stock when the institutions are selling. Look who's buying now. And think about this. Think about the selling we've seen in the market. A lot of stocks have come under pressure. There's been a lot of names actually have bearish Chaikin money flow readings. Look at Molson Coors. Look at the intensity of this bullish money flow. Stock gapped higher. It's gone sideways. Actually triggered an oversold buy signal yesterday, and it's on my screen today. This is a name that you should consider on the long side, especially in this market environment. The research is done for you. And to take it one step further, because we understand that maybe you can't log into Chaikin Analytics every morning and go through this research and run these screens. But what you can do is maybe you have one day a week that you can dedicate to logging into Chaikin Analytics, running these screens, and then you can build a watch list. Your watch list is your ideas that look compelling to you, that you want to keep an eye on and wait for an prime opportunity to get into the stock. So what do we do for you? Daily email alerts based on your watch list. Every day you will receive an email. And if something important happens in one of the names on your watch list, you'll be alerted to it. So on June 26th, I actually had a bullish watch list that I was looking at for potential ideas. Remember, I said software was leadership before rolling over recently. So I was looking at a lot of software names and looking for compelling opportunities to enter on the long side. I had Citrix on my watch list. I received my email, and I saw that Citrix had triggered an oversold buy signal. There's that buy signal just over $100. Made it a bullish stock of the day for Chaikin Analytics members right before it ran to $115. And it met all the criteria. Again, the repeatable process was in place, outperforming the market, oversold, bullish money flow, triggers a signal, and we enter the idea. But as we've said now, the market has changed. The dynamics of the market have changed, and it has become more defensive. Does that mean we just go to cash? Absolutely not. There are still plenty of opportunities out there, because if you're playing good defense, that leads to good offense. And it was actually in my note back in the October timeframe when the market broke 2873 to the downside, which had been the previous high from January. I said it's time to become more defensive. I didn't say to get out of the market. I didn't say to go to cash. I informed our investors that now was the time to become more defensive. Look at the sectors of the market that are traditionally defensive. And remember, I showed you the sectors earlier? Utilities and real estate were at the top of the pack. And look what was going on here as the market was topping. Institutions were selling. There's that bearish money flow sell alert. It works at the ETF level as well. So now what do we have? Consumer staples are now leading the market. This chart is as of today. The XLP has the bullish rating and it's outperforming the market. The dynamic duo is in gear. So even if you're just trading ETFs, the same process applies. Bullish money flow. The fund was recently oversold. It's pulled back to the trend line. But more importantly, we know consumer staples is an area of the market where we want to go looking for long ideas. Now remember, the market's been selling off since October, but we're identifying long ideas. We're just finding them in the right parts of the market. Here's Helen of Troy. It's a soap and cosmetics company. Regardless of your view on the market, regardless of your view on the economy, even if you thought we were going into a recession, you're still going to wash your face and hands. Helen of Troy set up a compelling opportunity right here when it triggered this oversold buy signal. Money flow is still bullish, outperforming the market. We identified the stock at around $112, on its way to about $142, where it's still trading. This chart is as of today. Another part of the market that's beginning to outperform, or has been outperforming since October, again, the utilities. They've actually been the leading sector for us in Chaikin Analytics since the market topped out. We've identified a few winning trades to the long side in the utility space, and one that still looks compelling to me now is American Electric Power, ticker symbol AEP. Here's your bullish rating, outperforming the market. Look at money flow. Nobody's selling this stock. Institutions are not selling this stock. We've broken above key resistance at $77. AEP looks like a compelling name as we're heading into 2019. And it's this type of process, right, that Alex, back in March when the market was first turning over, think about what it would be worth for you, what it would do for your portfolio if you could identify winning bullish ideas in declining markets as it was now in March and as it is now. Can't tell you how happy and grateful I am to have found Chaikin Analytics. Alex found us through Jim Cramer, and it has changed his investment life. But just as important as knowing what groups to look for long ideas, we need to know what groups to avoid. Leisure and entertainment has been a group to avoid really since the summer. This is the PEJ ETF, consumer discretionary. It's the leisure and entertainment ETF. And you can see underperforming the market starting in the July timeframe. Institutions selling, breaks through support. This is where I was able to go hunting for bearish ideas, right? We look at bullish ideas. We also look at bearish ideas because no matter what the market environment's doing, using our process, we can find winners on both sides of the market. Winners like Wynn. I'm sure you've all heard of Wynn, the resort company. This could easily have been a classic Chaikin bear. Rolls over. Look at what happened at the highs. Stock was trading in the $190 to $200 range, but look who was selling. Stock begins to underperform the market in June, goes into a steady downtrend. Rallied back and triggered an overbought sell signal with bearish money flow. We identified an options trade, a bearish put spread that returned 158%. What would that do for your portfolio if you could find winners on the long side, even as the market's going lower, as well as take advantage of that downside volatility? Domino's Pizza, another example. We delivered with an options trade, delivered 100%. Stock was in a steady uptrend, but near the highs, the institutions were selling. Stock began to underperform. Right in front of this earnings announcement, which disappointed investors, we identified a bearish put spread that returned 100%. Healthcare equipment. Remember I said healthcare was outperforming, but you had to know which parts of the market to be in. We help you do that. That's why relative strength is so important. You had to drill down to the industry level. Healthcare equipment was a big winner, but now it's beginning to lag. And back on November 21st, we identified a healthcare equipment company called Quidel. We opened an options trade on November 21st with the stock around $60, $61. We closed that trade yesterday for 117% profit after the company received an unfavorable court ruling late in the day on Friday, and the stock actually continues to bleed out, but we weren't going to look a gift horse in the mouth. We took our opportunity, 117% profit in 2.5 weeks, walking through this system. Notice the stock was underperforming the market. Notice that power gauge rating at the time of the trade was bearish. So now I'm going to open it up. I want you guys all to use the Q&A window. I want to play a little game because we started out by talking about the types of names we want to own and the types of names we want to avoid. So I'm going to ask you, just type your answer into the chat box. Would you buy this stock? Right? Bearish rating, underperforming the market, bearish money flow, especially up here near the highs.
A lot of no's coming in, Dan.
A lot of no's coming in. Remember, we talked about your emotions. Your emotions apply to the stocks as well. If I ask you that question now, would you buy this stock? Would your answer change? This is Apple. Your answer should not change just because I told you it's Apple. A lot of times our emotion gets in the way, right? We use the phone, we use the tablets, we probably have a Mac somewhere in our house, right? Apple's identified as a great company. We help you take your emotions out of the equation. Apple's a very bearish stock that's underperforming the market with bearish money flow. And look what happened near the highs here at 230. Apple became $1 trillion company, continued to run. The institutions were selling the stock. And one more time, would you buy this stock based on everything that we've talked about today?
More no's flooding in.
Looks like no's across the board. I don't see any yeses. And And that shouldn't change just because I tell you that that stock is Netflix. Another bifurcating name, another name that investors love to love. Take your emotions out of the equation. Let our objective, done for you research keep you from buying a name like Netflix as it's rallying to $380 and everybody's talking about how great it is. No. Bearish rating, underperforming the market, becomes overbought with bearish money flow. It triggered an overbought sell signal at around $375. Both myself and Mark Chaikin, Mark in his weekly note, and then myself in one of my daily notes, made this a bearish stock idea. Stock's trading around $260 today. So back in 2017, Chaikin Analytics was selected for the 2017 Benzinga Global FinTech Award for Best Idea Platform. And one of the aspects of the platform that helped us win this award is one that I use on a daily basis. Again, we're talking about finding ideas. It's our discovery tool. Now, maybe we talked about Netflix, and maybe, you know, we all can't help it. I'm a huge Netflix user. I don't have cable TV. I only watch, you know, Netflix and some other streaming services. So maybe that alone keeps me from getting bearish on the stock, right? We all have our emotions and our biases. But if I say, well, but what about other stocks like Netflix for potential bearish opportunities? By seeding our discovery tool with Netflix, I found 5 other names that could be potential bearish opportunities. And to be honest with you, I ran this last night. The one that looks most compelling to me, if you want to write it down, is WWE. And at the same time, we give you some potential swap ideas. We're telling you don't want to own Netflix. But if you're looking to own a name like Netflix, here are 5 names to consider. One of them is Rogers. Look at how much different this looks. Look at how this looks more like a Chaikin Classic bull as opposed to Netflix, which looks like a Chaikin Classic bear. Nice steady uptrend. Bullish money flow, even as the market is selling off. Outperforming the market, approaching oversold levels. I think this pullback to the $52 level to our rising long-term trend line sets up a compelling opportunity in ticker symbol RCI. So that's Chaikin Analytics. It's a proven stock selection system that provides the tools to not only help you get into a winning trade, but gives you everything you need to take profits and move on to the next idea. Chaikin Analytics sells for $21.95 for an annual subscription. And for that, you receive our 20-factor model, which combines fundamental and technical factors. You'll receive that discovery engine for finding other ideas. You don't want to sell Netflix. Maybe take a look at WWE or rotate into a name like RCI. So as I said, Chaikin Analytics normally sells for $21.95, but as a webinar special, we are going to give you a 1-year subscription to Chaikin Analytics for $17.95. We're going to knock $400 off the price if you head over to chaikinanalytics.com/stocks. You'll get that screener. You'll also be able to generate options ideas for you options traders out there. And we've added some recent additions. We provide intraday charts for you to take your timing a bit further. If you have the opportunity to sit in front of the screen and look at the stock on an intraday basis, you can find the opportune time. We'll give you earnings details. We'll let you know what they reported relative to what they reported a year ago and what the estimates were. And finally, or not finally, in addition, Mark's weekly market insights comes out every Sunday night. Gives you everything you need to know to prep for the week ahead. And plus, when you become a Chaikin member, you'll have members-only access to our weekly strategy webinar, which I host along with Josh, who's on the call here with me today. You'll get unlimited coaching from Josh and his team. You'll get their support, including small group sessions, as well as one-on-one coaching, and my daily morning insights, where I identify bullish and bearish ideas for you every day that the market is open. And as a fast action bonus, if you join by midnight tonight, you will receive 3 months of my Bearish Insights newsletter. The Bearish Insights newsletter comes out once a week on Wednesdays. If you sign up by midnight tonight, 3 months of the Bearish Insights newsletter for free, which identifies those bearish opportunities like Wynn and Domino's Pizza, regardless of the market environment, to help you take advantage of stocks that are likely to fall. And if you sign up tonight by midnight, you'll have that first newsletter in your inbox tomorrow, December 12th, via email. So Chaikin Analytics, normally $21.95, but as a webinar special tonight, $17.95, plus 3 months of Bearish Insights for free. That's $150 value. Subscribe by midnight tonight. Our team is standing by to help.
Dan, thank you very much for presenting today. Thank you, everybody, for attending today. To take advantage of Dan's generous offer, you can use the link. I put it in the chat window for you. It's www.chaikinanalytics.com/stocks, or you can call us 877-697-6783. Again, that is www.chaikinanalytics.com/stocks, or call us at 877-697-6783. Some of the bearish ideas that Dan showed you that we made 100% on those options trades came right out of his Bearish Insights and were handed to people. So take advantage of that offer. Again, chaikinanalytics.com/stocks, or call us 877-697-6783. We can have you on an onboard session, attending all of our client success sessions, and you have access to Dan Russo, our Chief Market Strategist. Thank you all, and look forward to seeing you in an upcoming member session.